I'm Charlotte McLeod with investingnews.com, and here today with me is Andy Hoese, founder of Finding Value Finance. Thank you so much for being here. Great to have you.
Yeah, thanks for having me on and inviting me on here. Thank you.
Of course, I think that many people in our audience are already familiar with you and your work, but I was thinking, just because it's our first time talking, if you wouldn't mind outlining your approach to investing, which I believe has three key pillars. So I wonder if you could begin with your process.
Yeah, so I approach the markets through kind of three different, I'll call it paradigms or viewpoints. I use technical analysis, I use market cycles, and I use ratios. The market cycles, what you see at tops and bottoms, you'll see overvaluation in some sectors at the top of their market cycle. You'll see low valuations or undervaluation in different sectors during that same portion of the cycle. So that kind of keeps you away from tops and towards bottoms. The ratios will tell you what that looks like real time. So the ratio of one asset class versus another asset class can show you what's topping, can show you what's bottoming, and I can give some examples later on if you guys want to see that. So you've got undervaluation, you've got the ratios that are cheap. That means you're at the bottom of the cycle. And then for technical analysis, you can see the actual bottoming pattern forming or the topping pattern forming depending on the asset class that you're looking at. So that's another indication if you're at a market top or a market bottom. And I use these three things because it gives you an unbiased opinion of if something's expensive or cheap and if you're at the bottom or top of a market cycle. So that's why I use those three for an approach.
I was going to ask, I was curious because a lot of the time when people use technical analysis, they might want to exclude all the other things that are going on. So how did you come to kind of a combined approach?
I think it gives you the largest probability of success. And if you take a really long time frame, I think it increases your chances of success even further. So I identify as a hybrid investor that uses both, quote, fundamentals and technicals. And I don't think the technicals work solely based off just the technicals, because if you can't identify if something's cheap or expensive, and you can't identify what market conditions you're in, your probability of success goes down substantially. So if you don't know that you're in a bull cycle or in a bear cycle, depending on what asset you're in, you're going to try to trade, let's say on the shorter time frame, you're either swimming upstream or if you've identified where the cycle is, you're swimming downstream, which is much easier, and you'll have a higher probability of success in your trades. If you're trading, will be a lot more successful. I don't really trade in the short term. I'm more of a long-term investor, trying to time the best I can market bottoms through the valuation and technicals, and then riding through the entire bull market, which takes, I would say, something like 10 to 20 years or longer. So I'm identifying the very big trends and buying very undervalued assets and then holding through the cycle. So that's kind of what my goal is, at least.
Yeah. I think the hybrid approach does make a lot of sense. It's interesting to see. And we should get into where you are seeing opportunities right now. Normally, I would start with gold or silver because our audience has a strong interest in those topics, and we will get there. But I think we should go in the oil direction right now because it's been in the headlines so much since the Iran war began. There's been a lot of price volatility. It seems like every time there's a war-related announcement, there's a big move or a quick move in either direction. So I wonder, how are you looking at the oil market right now? Or do we just need to weather this volatility until we know what way we're going?
Yeah, I'm a huge oil bull. I really like oil because of how cheap it is. And in fact, we can pull up a chart just real quick to talk about this. So we can go into the gold to oil ratio. And then we take a longer term kind of big picture view. Actually, let me flip this around. Crude oil divided by gold. What we can see, hopefully the lines pop up here. There we go. This is cheap oil when this ratio goes into, quote, the cheap area, which is down, I'd say below, in this particular case, 0.04. What this means is how many, 1 ounce of gold can buy how many barrels of oil, or how many barrels of oil can buy how many ounces of gold. And what I want to see over time is I want to buy gold when it's cheap, or when oil is expensive, so you swap your oil into gold, or you buy oil when it is cheap and swap your gold into oil. I think that this is the cheapest oil has ever been on a ratio perspective. So what this means is that gold's kind of our gold standard, is what I'll call it, the measuring stick. It's not dollars. And when you look at the ratio of oil to gold, and we've got these falling wedges which are bullish to break higher, I think that oil is probably one of the most mispriced assets at this time. And with the energy crisis that's coming with the war in the Middle East, I just don't see how oil stays at $80, $90 a barrel and this cheap against gold, with the largest energy crisis basically that the world has seen. So we're eating through inventories. Those inventories act as buffers. The buffers are depleting. And I think that energy is completely mispriced from a ratio perspective and from the crisis that I think we are in. So energy is definitely, oil in particular, is the best opportunity, one of the best opportunities at this time.
So you mentioned how oil is so mispriced right now. What is your longer term price outlook for oil? I'm starting to hear some, I think, very high price predictions at this point.
Yeah. So the first thing I'll say is I use these ratios and the technicals to basically establish a position. So I want to buy it when it's really cheap with very little downside and with a lot of upside potential. That's your asymmetry. The projections get a little bit hairy because we don't know for sure. So if I use it from a ratio perspective, I can easily get projections depending on if we were to go to an expensive state, which is very possible. We could go up to $400 or $500, $600 a barrel. Now, a lot of people will say, I don't believe that, and that's perfectly fine. But that's what the ratios would suggest if we were to go to an overvaluation against gold or the S&P 500. I also line up a lot of fractals. Fractals are repeating patterns that the herd psychology develops over time. So people interacting with each other and trading in markets create patterns. And the size of those patterns can be a predictive function of where the price could go. Depending on how you line up those predictive patterns, and fractals is what we call them, I get projections anywhere between $200 and $600 a barrel. Most of the projections occur around early 2030s as a peak. So that's kind of where it would peak out, like 2030, 2031, 2032, somewhere in that range. So that's kind of what I see would be a potential top. I know it's a gigantic range, and you can get to that range based off of a variety of ways of calculating it. I'm not too focused, or I don't think it matters how precise I am with a prediction. It's more about capturing that move and getting in low to protect your downside. So that's what I'll say there.
Yeah, I was going to ask you, is now the right time to get into oil if you haven't already? Because I know people are worried about that volatility. If that is where we're going, then definitely it sounds like it is. So I'll ask instead, what's your preferred way to get exposure to oil? I think a lot of the time I hear you can just buy the big companies, but how do you see it?
Yeah, so I would buy the equities. I would buy oil equities. I would buy energy service companies. And I would look at even the stuff around energy, like alternatives like coal and the equities in coal. So I would stay with more of the mid-cap companies, small to mid-cap area. I think they have the most leverage to the upside. The larger companies like the Chevrons, the ExxonMobils, they're very large. I don't think they have the upside oomph that I'm looking for. So the smaller mid-cap range, I think, is the sweet spot. It reduces risk where you're not going too small, but it gives you all the upside potential. It's the largest asymmetry that I can find in the market. So those are market caps around a couple $100 million all the way up to maybe single-digit billions. So somewhere in that range is what I would say is the ideal size. And natural gas, I like natural gas. I think coal looks very good, and the equities, and I think some of these Canadian oil companies look ridiculously good. They've already moved off their bottoms. They bottomed in April, May of 2025. And I think they're still good. They're still decently valued, and there's still a lot of upside potential.
I'll ask a little bit more about the case for coal. It's one that I've started to hear a little bit more about. Is that mostly based on just the high amount of energy that we're going to need? We're going to need every form of energy, or how do you see coal right now?
Well, Qatar is a large exporter of LNG, and they are completely shut down at this moment. They also have permanent, well, I will call it as permanent damage. It's about 5 years to fix with some of their LNG shipping capacity. So we've got some of it kind of more permanently offline, is what we'll call it. And then we've got some that is just shut in right now. So I think there's something like 17 to 25% of the LNG market which is shut in, which is a massive amount. So with that being shut in, and I'll just say the market not knowing when that's going to come back online, coal is going to take up the slack. So I think coal is going to be an absolute killer of an opportunity. And if you look backwards at a lot of these other bull markets, coal has been some of the largest outperforming commodities. So if we're coming into a bull market of commodities in general, and we've got this LNG problem with Qatar, I don't see how this doesn't go way higher over the next few years. So that's kind of the setup there in coal. I also think that they're pretty cheap, and the companies, they make a lot of money and they buy back shares. So they're good companies in a good sector that's highly leveraged with a short-term to medium-term problem in the LNG market.
Okay, that helps me understand how you're looking at that one. I wanted to, on the note of energy, bring up uranium as well, because it feels like it's being a little bit overlooked right now because of all the focus on oil. But it's a market where every time I hear about it, it seems like the fundamentals are getting better. So I wonder what your outlook is for 2026 when it comes to uranium.
Yeah, so uranium looks really good from a very long-term perspective. I think that we have to migrate towards nuclear. And then in the short term, I also think it looks good because with the energy demand in the short term, we're going to have to fire back up a lot of nuclear power plants, which then increases demand for uranium. So I think short term, medium term, long term, uranium looks pretty solid on all timeframes. The only thing that I'll say is the companies are a little bit more expensive. People are paying up a little bit more for the uranium companies themselves from like a price to book financial perspective. But the charts do look really good. And I think uranium has a long way to go to the upside. And if you want, I can share a chart here real quick.
Oh, yes,
I'm
please.
going to share, we'll just share Kazatomprom. So KAP. And I put a fractal overlay on top of it. Just what this is, and I don't know if a lot of people use this, but this is a pattern. It's an Elliott wave pattern. It's labeled wave 1, wave 2, wave 3, wave 4, and wave 5. I think that this is kind of what the bull market is going to look like through its movement. So it started in 2020. We'll call that the beginning of the supercycle for commodities. And we went through wave 1. You generally get a pretty long wave 2 pullback where it chops sideways and people get frustrated, which a lot of people did. We are in wave 3, and we're going to go probably all the way up to wave 5. I'd say early 2030s, just like oil, like I was saying, was going to peak somewhere in that early 2030 range. So I think this is probably what's going to occur, something on the lines of that. And towards the middle to back half, so somewhere in this section over here, you're going to see a lot of the junior companies just wake up. I mean, they're just going to start to absolutely do a full send to the upside. So you're going to see a lot of big moves in the uranium space. And I think the junior market that people probably aren't even looking at this time is really going to wake up. So that's what I'll say. That's what I'll say there.
Well, and you've mentioned 2030 a couple of times as when we're kind of coming to a head there, and you talked about the commodities super cycle as well. So is that the time frame that you see it all coming together for the commodities super cycle?
Yeah, so I think a big driver is a lot of things are aligning to the early 2030s for maybe a bigger pullback. That doesn't mean that the commodity super cycle is completely done. I just think there could be maybe a larger consolidation or pullback in the 2030 to 2032 timeframe would be my best guess. And that also aligns with, there's real estate cycles that also play behind this. And I have a feeling, and I don't know if this is going to be 100% true, but I think the real estate market's going to probably peak somewhere in that timeframe, late 2020s, early 2030s. Is a total. There's a little bit of guesswork in there. I'm not saying it's 100% fact, but that's kind of where my guess is, and that's also where all these commodity charts kind of line up. And historically, that's what we've seen. We've seen a real estate market develop during these commodity bull markets, which we are developing the real estate market from, I'd say, about late 2016, 17, 18, somewhere in there. We went into an expansionary phase of real estate. And we've been in a slowdown since 2022. And I think it's going to accelerate. I think they're going to do QE. They're going to try to lower interest rates. Something's going to happen there. I don't know when and what it looks like. And then I think the real estate market's going to push higher. And we could see my guess would be a recession out in the early 2030s. And that's when commodities will have a peak, for a rollover peak for a pullback. And then after that, I think we'll just continue to go higher, would be my guess.
Okay. That gives me a better idea of how you're seeing it there. So since we're talking about cycles, I think we've done a pretty good job covering what's going on in energy. I want to go over to gold, and I do usually start by asking people when it comes to gold, where do you see us in the cycle? So how are you looking at gold right now?
Very short term, I think we're in a consolidation pullback. I don't know if that's done or completed yet. I can do a quick showing you of what I think it looks like in a very short term. So we zoom way in. We're in this kind of big correction here, where generally you get kind of like these consolidations. So this could come back, and then maybe we head on higher over time. But this short term, we could get a little bit of a pullback in the short term. There's usually I call them a 3-hump consolidation, 1, 2, and then there's usually a third. Sometimes this can jump out of it quicker and not have to go all the way back to the bottom. So I think we're still in a consolidation for gold and silver in the very short term. Longer term, we're going way higher. We're going way, way, way higher. And the reason I think that gold, silver, and a lot of these precious metals are going to go higher is because of where we're at in the cycle. And the cycle here, I'm going to pull up, I'm going to just pull up a new gold chart that's got a little bit more history in it, and then US 10-year. Actually, I'm going to change this to silver because you guys can see it a little bit better. I'm going to go long-term line chart. So this is the silver chart on top. It was freely traded back in the 30s and 40s. That's why I'm using it. Gold wasn't freely traded before 1970, the reason I'm using silver. We had a long-term pullback in yields, and this is another long-term pullback in yields. And what we're seeing here is a consolidation bottoming pattern. So this is your kind of base. This is another consolidation, which is the cup and handle of this here. Think of it as kind of like a base or consolidation. And if you look at interest rates, when interest rates broke out and started moving higher, that's when silver and gold moved, but gold was not freely traded. So I'm using silver as an example. The consolidation of the big 45-year cup and handle pattern is because of interest rates declining. So interest rates have broken out. They bottomed in 2020. They've broken out in 2022. And I think we've entered a new bull market for silver, very similar to the breakout that we had back here in 1945. And I know maybe not a lot of people have talked about this. This is from a very kind of big viewpoint. When interest rates get above 5%, which we've been consolidating right underneath 5%, that's when you start to see an acceleration of silver and gold. Now, we've been consolidating just underneath it. So it's like it's been held together. The markets have been held together because I think maybe they're in there doing something with interest rates. I don't know. But when we cross 5%, the stock market will sell off most likely. You'll see a rollover in the S&P 500. And then I think you'll start to see an acceleration of both gold and silver to the upside. So 5% on the US 10-year yield. When we cross that, I think the S&P is going to struggle. It's going to be a headwind. And money is going to rotate into gold, silver, and commodities. So gold and silver look fantastic from a long term. I'm not worried about the short term. Short term market timing is very difficult. And I don't do it. I just sit through these things. I move it up here. And I think we're just in a little consolidation that we've got going on here. So that's what I currently see.
Well, and I think that answered the question I was going to ask. A lot of people are looking at gold and silver and they're wondering, all right, what is going to be the trigger that pushes them into their next leg higher? So I feel like we went over that. I wanted to ask, you're mentioning the S&P, and I think that's one that people also have a lot of questions about. So we're in a war right now. There's a lot of turmoil going on, yet we see the markets keep moving higher. They're reaching all-time highs. What do you make of that? Is that something that needs to come to an end sooner than later, or what do you think?
Yeah, so I'll pull this up real quick, give you guys a big picture view of the S&P 500. The S&P 500, when we go through these big consolidations, these are commodity bull markets. Commodity bull market, commodity bull market, commodity bull market. And you can see that in the ratios of commodities priced in the S&P 500. I think that we are entering a commodity bull market, and it would be my best guess that this is going to turn over and go into what they consider to be a lost decade. So if these were the commodity bull markets previously, I see no reason to think different that this is not going to create some sort of sideways pattern. So if I were to kind of just grab this, I think that this will eventually, I can't perfectly put it on here, but it'll do something like that. And you'll have this same kind of lost decade. Precious metals will move to the upside. You'll see all these commodities move all kind of in tandem. Another thing that they do is we could see a slowdown in the market at some point out in the future. Maybe it's the 2030s that I was talking about, where we kind of maybe this rolls over in that time frame. And then when it rolls over, they're going to lower interest rates and all that, or maybe they're going to lower interest rates now because the debt situation that we're in. And then they just print a bunch of money and buy a bunch of bonds. So that could also have an impact on if this goes up or not. If they lower interest rates or do quantitative easing or yield curve control, you could see this go up further and longer, the S&P. So maybe it's something like that. And we could see commodities run up with it, and precious metals. If they do QE, I have a feeling that you're going to see the dollar, the DXY, drop. So you'll see this come under pressure and go lower if they do that. So they're going to transfer the pressure that's mounting in increasing interest rates. They'll say, no, we're going to hold this down, maybe underneath 5%, and then transfer the pressure into a weaker dollar. And the weaker dollar, since these commodities are all priced in dollars, will go up. And we've seen that historically in all these different commodity bull markets. This was the 1970 to 1980 run. This one here was from 85 down to, we'll call it 1990s. We had another run from 2002 to 2008. And then I think we're going to see another bull run for commodities here whenever they decide to do that. So that's another thing to look at if you guys are bullish on precious metals and commodities. And another thing even for the S&P 500, because if they hold it underneath 5%, which is kind of like that critical level, that's when the S&P could still go higher if they're printing money and doing that.
Definitely, that's one to keep an eye on as well. And talking about what's going on in the market, and I'll relate this back to gold, silver, mining stocks as well. A big concern right now is inflation. So higher oil prices, how is this going to impact inflation? And a question that I'm seeing people ask is, what does it mean for the mining companies? So gold and silver prices are high right now, but what happens when their costs start going up? So what are you looking at in terms of inflation right now? Is it a concern for you? And how could it end up impacting these companies down the road?
Yeah, that's a good question. And I think we're going to consolidate in the miners. I think. Not for sure. And it's a difficult one because they're making a lot of money. The mining companies, I mean, it's cash flow, it's earnings. And that's generally what drives stock prices, are higher earnings. What's difficult is how fast, where's oil going to go? How much is it going to go up? Where's the demand destruction going to hit? What are interest rates going to do? Because in increasing interest rate environment, generally you'll see gold and silver consolidate. And that's kind of what we're seeing. We're seeing that consolidation start right now. We've also seen the 2-year yield break to the upside. And I'll just show this real quick so people can understand what I mean. This is the 2-year yield. Yields are a big deal because they have an impact on how money flows in the markets. That's why I'm looking at yields so much, just as some background. And we've recently just broken out of the 2-year in the short term. So this is a pattern. We squeezed up into the corner and we've broken to the upside. And this could be the start, which I think it is, of an increasing interest rate move. And in the 2-year, it generally moves first because it moves the quickest. The longer end of the curve is more anchored than the short term, and it kind of moves a little bit more in the short term. So I'm using the 2-year as an indication of what inflation's doing. When gold did very well, this 2-year peaked basically here. So it peaked in September, October of 2022. We'll put gold here as a new pane, and you can see kind of where gold started to take off. So this peak here, this is kind of where it peaked out. We went into a big consolidation, and then you could see gold take off. I think what's occurring now is that gold's going to go into a consolidation with interest rates moving higher. So with interest rates moving higher, with I think oil and energy most likely going to outperform because basically the bond market's saying it's time for it. We can also throw a ratio of, let's say, a oil energy, PSCE, which is a small cap energy fund, versus say GDX, which is the miners. Sorry, I'm going into ratios here on a GDX, on a gold mining deal here. So what this is this is your out of cycle. So PSCE outperformed up to 2014. We have a nice big falling wedge What that means is that the buyers start to equal the sellers and create a bottoming pattern. This is your bottom. PSE, which is a small cap energy fund divided by gold and silver mining companies, GDX, which is the bigger ones. We're putting in this big double bottom in a base. So I think that this is going to basically bottom here, and we're going to start to see an outperformance of energy versus the gold and silver mining companies. And this is right here at the bottom. So it's a very early call. The early call would be actually here in 25, 26, right at this bottom. I think that this is going to break this bottom and run higher with interest rates and higher energy prices. And I think the gold and silver mining companies are going to underperform energy. So that's why I'm so excited about, say, energy, and why I'm so bullish on energy, and maybe not so much on metals and the gold and silver mining companies. It's because of what interest rates are doing, the situation that we're in with the Middle East, and what I'm seeing in some of these ratio charts is suggesting that we could see an outperformance of energy versus a lot of these other areas. We could also, just to extend it to just another thing, we could also do it against copper, COPX. And we're seeing very, very similar chart patterns all kind of line up for a potential bottom. And that's energy versus just copper mining equities, just to give you another example of not just looking at two asset classes, but extending it across more than just a few. So that's where I'm getting my bullish call on energy. And that's kind of what it's rooted in. It's in a bunch of different ratios, a bunch of different charts, a bunch of different bottoming patterns, and then coming to the conclusion that energy is most likely going to outperform here in the short term and longer term.
Yeah, I think we brought it all together there. And you threw in copper, which was the last one I was going to mention. I think that's an interesting one because we've got commodities supercycle, but then copper is so Dr. Copper connected to the economy. And if we're going into a recession, that makes that quite interesting. So I think we covered what's going on there, unless there's anything else you'd add on the copper side.
Yeah, so I'm super bullish on copper. I think it looks really good. It's cheap in relationship to gold. So I think copper's got a long way to run. And even though I put there the small cap energy versus the copper equities, energy is just really cheap. It is really, really cheap. So it's hard for me to choose a little bit more progressed sector. Copper's already running, so we could still see that stay down for a little bit longer, that ratio of energy versus the copper equities. But copper looks good. And I think it's I'll call it a solution to the problem that we have in energy. So I think copper is going to run to the upside for a long time. We also have a lot of deficits coming out in, the next decade plus. So I think I think we'll get behind in copper, and I don't know what's really going to stop it, maybe for the rest of my life. It's going to go for a while. So it's super bullish, looks good. And some of the copper equities are not as cheap as, say, the energy equities. That's the only kind of downside on it. So it looks good.
Yeah, so it looks good. It's just energy looks so good right now. Okay.
Energy is ridiculous.
Yeah. Okay. Okay. Well, I think that covers all the topics I wanted to go over. I'll let you go unless you had any final thoughts you would leave investors with. I think it's a bit of a tricky time for people to be in the market.
Yeah. So what I would do is I would approach the markets from a value perspective and from a long-term time frame. The shorter-term time frame, I think, is going to be very difficult to nail here. A lot of moving pieces. A lot of people think that a recession is going to come, and maybe that's going to be the case with the disruption in energy. So it's a tough time to kind of ride through these things. But longer-term time frames are generally good, and I think the opportunities here are about as good as they get for, I'll say, our time frame. So I think energy is probably the best generational opportunity that I see here, probably ever in our life, because it's got the cheapest ratio against gold and against the S&P 500. So that's where I'll leave it.
Yeah, hard to argue against energy right now, I think. Well, thank you so much for coming on to talk. This was great. It was very educational, and hope to have you back again in the future.
Yeah, thanks for having me on, Charlotte. Appreciate it.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Andy Hoese with Finding Value Finance.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.